So the fifth largest pizza chain in America. It doesn't have delivery drivers.
Right.
It doesn't have those, classic checkered tablecloths. And realistically, you probably buy your gasoline there.
Yeah, which is always wild to think about.
It totally is. Welcome to the deep dive, where we take the raw materials, corporate earnings calls, financial filings, transcripts, and we just kind of distill them down into the actual mechanics of how a business operates.
Exactly.
If you are joining us today, you are probably looking for an edge. You're trying to figure out how certain companies just seemingly defy macroeconomic gravity.
And today is a perfect example of that.
It really is. Today, we are looking at an absolute masterclass in fundamental analysis. We've got the full, unvarnished Q4 2026 earnings transcript from Casey's General Stores.
Ticker symbol CASY.
Right. And we are going to tear it down to the studs.
Because, it's a company that frequently suffers from this massive perception gap, right?
Oh, 100%.
When most people outside the Midwest think of a gas station or, a convenience store, they picture, dusty shelves, stale chips.
Suspicious hot dogs on those roller thing.
Exactly. A purely transactional, low-margin environment. Like it's just a necessary evil of commuting.
Right.
But to actually understand Casey's, you have to completely discard that stereotype. You have to realize that they are operating this highly sophisticated, multi-layered retail ecosystem.
They really are.
They are a grocery store, a community hub, and a massive quick service restaurant, all sharing the exact same roof.
Yeah, and they operate thousands of these locations.
Right. And in many of the rural or suburban markets they serve, they are literally the only viable grocery option.
Wow.
The only hot food option and the only fuel option for miles in any direction.
So, we are essentially looking at a localized spatial monopoly in a lot of these markets.
Basically, yeah.
And the numbers they just reported for fiscal year 2026, they reflect exactly that level of dominance.
They absolutely do.
Let's actually look at the scorecard here because the financial footprint is just staggering. So for the full fiscal year 2026, Casey's posted a diluted earnings per share of $19.16.
Which is huge.
It's a 31% increase year over year. Net income came in at $714 million, which is also up 31%. And their EBITDA, which, we always look at as the clearest proxy for core operating profitability before all the capital structure and tax stuff gets in the way, that hit $1.5 billion.
$1.5 billion.
Yeah, a 23% jump.
And to put that 23% EBITDA growth into, the proper context, you really have to look at the macroeconomic environment of this past year.
Right. It hasn't exactly been easy out there.
Not at all.
Yeah.
We are talking about a mature, highly saturated retail industry that's operating during a period of intense consumer pressure.
Yeah.
You've got volatile commodity costs, sticky inflation.
The consumer is getting squeezed.
Exactly. So growing EBITDA by nearly a quarter on a base that large, that isn't just about, tweaking some prices or riding a macro tailwind.
Right.
It requires fundamental operational leverage. And what's honestly most revealing is how they finished the year. The momentum actually accelerated into the fourth quarter.
And I definitely want to isolate those fourth quarter specifics because Q4 is, it's notoriously tricky for retail, right?
Oh, absolutely. Lapping post-holiday lulls is tough.
Exactly. But in Q4 alone, their EPS came in at $4, which is a massive 66% year-over-year increase for that specific quarter.
66% in one quarter. It's
right.
Wild.
Q4 net income was up 65.5% to $162.7 million.
Yeah.
And Q4 EBITDA reached $350.3 million, up 33.2%.
Yeah, they didn't just coast across the finish line of the fiscal year. They basically sprinted through it.
Completely crushed it.
Which brings us to the most critical aspect of these paper profits, I think, which is capital allocation.
Oh, for sure. Translating that to actual money.
Right, because a company can post impressive accounting earnings all day, but the true measure of financial health is cash generation.
Mm-hmm.
And, how management actually deploys that cash.
Yep.
So if we look at their free cash flow profile, they generated $722 million for the fiscal year.
Which, just for anyone listening, that is the actual liquidity generated by the business after keeping the lights on and maintaining their existing asset base.
Right, the real money left over.
And embedded within that $722 million free cash flow figure is a very specific tax strategy.
Oh, this is fascinating.
Yeah, management noted an approximate $100 million cash tax benefit related to their capital spending. They are heavily utilizing bonus depreciation.
Which makes sense.
Right. For a capital-intensive business that is, constantly building new physical stores and ripping out old kitchens to install these massive commercial pizza ovens.
Yeah, those aren't cheap.
No, they're not. The ability to accelerate depreciation schedules is just a massive lever for them.
Right, because it allows them to pull forward cash flow that would otherwise go straight to the IRS in the near term.
Exactly.
So keeping that $100 million on the balance sheet, they can either, reinvest it in the business or return it to the shareholder.
And that near-term liquidity is vital right now, especially when you consider the cost of debt in this environment.
Oh, absolutely. By retaining that cash through tax efficiency, they're basically funding their own expansion internally.
Rather than tapping into those really expensive credit markets.
Exactly. And on top of that, they are aggressively returning capital to the shareholders. I mean, they announced a 14% dividend increase, taking the payout to 65 cents per share.
And we have to pause on that because that dividend hike is a massive signaling mechanism. This marks their 27th consecutive year of increasing their dividend.
27 years.
Think about that. If you look back over the last 27 years, they have navigated the dot-com crash, the 2008 global financial crisis.
A literal global pandemic.
Right. And the highest inflation environment in 4 decades. And through every single one of those macro shocks, the underlying cash generation of the business was strong enough to support a steadily growing check to the shareholders.
It's just a fortress of a balance sheet.
It really is. And on top of the dividend, they just authorized a new $1 billion share repurchase program.
$1 billion?
Yeah, with $200 million of that expected to be deployed in fiscal 2027 alone.
The mechanics of that $1 billion buyback are so crucial to understand for anyone holding the stock.
Break it down for us.
So when a company with a strong balance sheet initiates a buyback of this magnitude, it has this profound effect on their weighted average cost of capital, or WACC, and obviously their future earnings per share.
Right.
By systematically entering the open market and retiring their own equity, they are permanently shrinking the denominator in the EPS calculation.
So there are fewer slices of the pie.
Exactly. Every remaining share instantly represents a larger fractional ownership of that $1.5 billion in EBITDA we talked about.
It's highly accretive.
Assuming they're buying the stock at a reasonable intrinsic valuation, yeah, it's incredibly accretive.
Which brings up, honestly, the most important metric for any company that's in expansion mode, which is return on invested capital, or ROIC.
Oh, yeah.
Casey's reported an ROIC of 12.7% for the year. That's the highest it has been since a weird tax-aided year back in 2018.
Right.
If their cost of capital is sitting somewhere in, say, the mid-single digits, generating a nearly 13% internal return creates massive economic value.
It really is the ultimate metric of management efficiency. I mean, earning 12.7% internally when the risk-free rate is as elevated as it is right now.
Yeah, it's impressive.
It proves that their strategic initiatives are highly capital efficient.
Yeah.
They aren't just, growing for the sake of empire building. They are growing profitably.
Okay, wait, stop. I need to push back on this narrative before we, crown management as completely infallible here.
Okay, let's hear it.
I am looking at the wholesale gas charts from this exact Q4 period, right? And oil prices were spiking.
They definitely were.
Wholesale gasoline was highly volatile. If the core product that drives traffic to their location's gasoline was surging in costs, their fuel margins should theoretically be getting crushed.
On paper, yes.
Right, because economic gravity dictates that when input costs spike rapidly, a retailer either, eats the cost and destroys their margin, or they pass it on to the consumer and destroy their volume.
Yep, that's the classic retail trap.
Yet they posted record profits. Are these headline numbers just some temporary accounting mirage driven by pump volatility? Are they actually growing the core business?
See, that is the exact question every single institutional investor was asking going into this earnings print.
It's the elephant in the room.
Totally. If these record margins were purely a byproduct of geopolitical oil volatility, then Casey's is just a cyclical trade, right? It's not a long-term compounder.
Exactly.
But the data from the transcript tells a completely different story. To understand why they are basically immune to that margin crush, we have to look at the internal architecture of their operations.
Let's get into it.
Management internally refers to their strategy as the advantage business model, or more simply, they call it the mousetrap.
The mousetrap, I love that. It implies a mechanism designed to capture something very specific.
Exactly. It captures foot traffic and converts it into high-margin transactions.
Makes sense.
The mousetrap is built on 3 distinct levers: prepared food, inside grocery, and the pump.
Okay.
Most convenience operators lean heavily on 1, maybe 2. Casey's has completely integrated all 3. If we start with the first lever, prepared food and dispensed beverage, which essentially operates as a standalone quick service restaurant inside the store,
Right.
we can see why the fuel volatility didn't derail them at all.
Let's look at the Q4 data for prepared food then. Same-store sales were up 6.6%.
Solid growth.
Yeah, but the gross margin is the true standout here. It's 59.5%. That's up 13.8% year over year.
I mean, clearing nearly a 60% gross margin on a massive food service operation. That is top-tier restaurant profitability.
It's insane. What is driving a nearly 14% jump in margin in a single year?
Well, it's a combination of commodity tailwinds and just really aggressive operational discipline. So CFO Steve Bramlage noted that cheese costs, which represent the single largest variable input cost for a pizza operation, they dropped by about 6 cents per pound compared to the prior year, settling right around $2 a pound.
Okay, at their scale, a 6-cent drop on millions of pounds of cheese is definitely material. But Bramlage explicitly said on the call that the commodity tailwind only added about 15 basis points to their overall margin.
Right.
So that leaves a massive gap to explain the rest of that 13.8% improvement.
Yeah, and the vast majority of that margin expansion was driven by what management termed self-help.
Self-help.
Specifically, they completely overhauled their store-level waste management.
Oh, wow.
Yeah. The food service industry, waste is the silent killer of margins.
Oh, I'm sure.
It encompasses everything from proofing too much dough that expires before you can use it to keeping items in the hot warmers past their hold times.
Right. Nobody wants a stale slice of pizza.
Exactly.
Oh.
Or even just poor localized demand forecasting that leads to over-prepping ingredients.
Executing a waste reduction strategy sounds super simple in a corporate boardroom.
Right. On a spreadsheet, it's easy.
Yeah, but doing it across thousands of locations with 50,000 hourly employees, that is a monumental operational challenge.
It really is.
It requires predictive analytics to forecast exactly how many slices of, say, pepperoni pizza a specific store in rural Iowa will sell on a rainy Tuesday versus a sunny Friday. It requires precise supply chain alignment so ingredients arrive just in time. The fact that they successfully implemented this discipline at the store level and actually flowed it directly to the bottom line shows that this management team has incredible control over their physical operations.
They really do.
Yeah.
And, while they were optimizing the cost side of the food equation, they were simultaneously launching their most ambitious top-line catalyst in years.
The wings!
The chicken wing rollout, yes. By the close of Q4, fully sauced wings were live in 850 stores.
I have to say, the transcript commentary around the wing business is just fascinating to me.
Oh, it's a game changer.
CEO Darren Rebellis projected that over the long term, the wing category could eventually rival the sheer size of their pizza business.
Which is a wild statement.
Right. Given that they are already the 5th largest pizza chain in the country, suggesting that wings could reach parity with pizza implies a multi-$100 million revenue stream just being built from scratch.
And the unit economics of the wing rollout proved that this isn't just like some menu novelty, it's structurally changing consumer behavior.
How so?
Well, management tracks the purchase data really closely, and they found that when a customer makes a standalone wing order, meaning they visit the store specifically for wings without, attaching it to a pizza.
Okay.
That specific customer's overall frequency of ordering prepared food increases by 30%.
Wow. So they're essentially fabricating a brand new purchase occasion.
Exactly.
Historically, the consumer mindset was, hey, let's order a whole Casey's pizza for family dinner.
Right. A very specific time of day.
But by introducing high-quality wings, they are capturing the lunch crowd, the afternoon snack demographic, and the weekend sports viewing occasion.
They are giving the consumer a reason to enter the store at, say, 2 p.m. on a Saturday.
Which is normally a dead zone for foot traffic.
Totally. And we have concrete data on the maturity curve of this product, too. In the Des Moines market, where wings have been available for over a year and that initial novelty is kind of worn off,
Right. The honeymoon phase is over.
Exactly. Same-store wing sales are still compounding at a 20% growth rate there.
That is incredible. That 20% mature market comp is the proof of concept right there. It demonstrates serious product stickiness.
Yeah, it does. But, the prepared food lever isn't just about wings. It is heavily anchored by their pricing strategy on pizza.
Oh, this is such a good point.
Over the past 12 months, if you look at the major national pizza chains, the Domino's, Papa John's, and Pizza Huts of the world, they have generally implemented price increases of roughly 2.5% to combat their own wage and commodity inflation.
Which is standard. But Casey's held the line.
They did.
They haven't raised the retail price of their whole pies in 2 years.
That's a massive competitive advantage.
They have intentionally structured their pricing to sit $1 to $3 below the national pizza chains.
Right.
In a highly inflationary environment where the consumer is aggressively hunting for value, maintaining that price gap is a brilliant market share acquisition strategy.
It's a very calculated trade-off. They're basically willing to absorb a slight compression in theoretical unit margins to capture a massive acceleration in volume.
And the data completely validates the strategy. Despite holding prices flat, their whole pie volume increased by 10%.
10% more pies out the door.
Yeah. Because the fixed costs of the pizza operation, the commercial ovens, the real estate, the baseline labor, those are already sunk costs.
Right. They're paying for that whether they sell one pizza or 100.
Exactly. So that 10% incremental volume flows beautifully through to the operating profit line. They are systematically training customers to view Casey's as the premium value option in the quick service pizza category.
They really are.
So, okay, the food operation is a massive engine of profitability. Now let's look at the second lever of the mousetrap, the inside grocery and general merchandise.
The traditional convenience store footprint.
Right. For Q4, same-store sales in this category were up 5.1%, and the margin expanded by 90 basis points to 35.7%.
And that 90 basis point expansion is entirely driven by what the analysts like to call a margin accretive mix shift.
Okay, let's strip away the Wall Street jargon for a second.
Please do.
A margin accretive mix shift simply means that out of all the items sitting on the shelves, consumers are disproportionately buying the specific items that carry the highest profit markups.
They're mixing their basket with higher yield products.
Exactly.
And the most profound structural shift happening inside the store right now revolves around the tobacco back bar.
Oh, this is huge.
Historically, the convenience store industry relied heavily on combustible cigarettes to drive foot traffic.
Right.
But combustible volumes are in a state of terminal secular decline. People are just smoking less. What is replacing them is a massive surge in nicotine alternatives, specifically smokeless pouches like Zyn and various vapor products.
And the mechanics of this shift are highly, highly favorable for Casey's.
Oh, extremely.
A tin of nicotine pouches carries a fundamentally different margin profile than a pack of traditional cigarettes. Combustibles are heavily burdened by excise taxes. They take up massive amounts of physical shelf space behind the counter, and the gross margin percentage is relatively thin.
Yeah, they're kind of a pain to stock.
But nicotine pouches, they have a much smaller physical footprint, they turn over faster, and the retailer captures a significantly higher percentage of the retail price.
And recognizing the structural shift early, Casey's proactively re-merchandised their stores.
Which is so smart.
Yeah, they physically shrank the square footage dedicated to combustible cigarettes and reallocated that prime real estate to the high-margin alternatives. They optimized the back bar to capitalize on where consumer demand is heading, not where it's been.
And it isn't just nicotine driving the inside sales either. The beverage coolers are performing exceptionally well.
Yeah, management explicitly highlighted the strength of non-alcoholic beverages, particularly the energy drink category.
The energy drink segment is essentially the high-margin anchor of the modern beverage cooler.
It totally is.
And to demonstrate their scale and influence, Casey's actually partnered with Monster Energy to secure an exclusive flavor.
Oh yeah, the red, white, and blue RAS flavor.
Right, which was tied to a philanthropic initiative.
The leverage required to secure an exclusive SKU from a global conglomerate like Monster, it cannot be overstated.
No, it's massive.
It proves that beverage manufacturers view Casey's not merely as like a distribution point, but as a brand building destination.
Because they held exclusivity on that specific flavor from late January through early May. If a consumer wanted that product, They had to drive past 3 competing gas stations to get to a Casey's.
It acts as an incredibly powerful traffic driver.
It does. And the philanthropic angle, using a portion of the proceeds to raise hundreds of thousands of dollars for the Warriors and Children of Fallen Patriots foundations, that builds deep generational goodwill within their localized communities.
It's just smart business. But while energy drinks drive high-frequency traffic, CFO Steve Bramlage pointed out another massive, structurally protected advantage in their beverage strategy.
What's that?
Their liquor assortment.
Ah, yes.
This is a widely underappreciated aspect of their moat. Bramlage noted that Casey's currently holds over 1,500 active liquor licenses across their network.
1,500? We really need to dive deep into the mechanics of liquor licensing here, because this isn't like stocking a new brand of potato chips.
No, not at all.
In many states and municipalities across the Midwest, liquor licenses are tightly capped by population density or just strict local ordinances.
Right.
Acquiring a new license can take years of lobbying local city councils. It can cost tens of thousands of dollars in legal and administrative fees. And in some highly restricted counties, it is functionally impossible for a new entrant to even obtain one.
Precisely. Those 1,500 licenses represent a regulatory barrier to entry that competitors simply cannot replicate.
They just can't.
If a generic convenience chain wants to enter a rural Iowa market, they might be able to sell beer, but they likely won't be able to secure the rights to sell spirits.
And the margin profile of hard liquor is significantly superior to that of beer.
Exactly. So by continuously expanding their liquor footprint within their existing stores, Casey's is building a high-margin revenue stream that's literally protected by municipal law.
Which brings us to the third and final lever of the mousetrap, and honestly, the direct answer to my earlier pushback regarding volatile oil prices.
Right, lever C, the pump.
The Q4 data here is entirely counterintuitive. Same-store fuel gallons sold increased by 1.5%.
Okay.
But the true anomaly is the fuel margin. They achieved an all-time record fuel margin of 46.9 cents per gallon.
Wow.
That is a massive 9.3-cent increase over the prior year. And all of this occurred while the average retail price paid by the consumer surged 14.1% to $3.40 a gallon.
Yeah, this is the core paradox that basically baffles traditional economic modeling.
It doesn't make sense on paper.
How does a company expand its per-gallon profit margin during a period of rapidly escalating wholesale costs? Why didn't the margin compress?
Tell me.
To decipher this, you really have to look at the competitive landscape of the American fuel retail industry. It is fiercely fragmented.
Okay.
Roughly 2/3 of all gas stations in the United States are operated by independent mom-and-pop owners who control 10 locations or less.
Wow, 2/3.
Yeah. And these independent operators are the key to the entire margin equation. Let's look at the physical reality of running a single independent gas station in 2026.
It's bleak.
The operator is facing relentless inflationary pressure. Their property insurance is skyrocketing, their utility bills to keep the canopy lights on are surging, and they have to raise wages just to keep cashiers from leaving for, other retail jobs.
And crucially, because wholesale gas prices are up, their credit card swipe fees are up.
That is exactly right. But unlike Casey's, that independent operator does not have a massive 60% margin pizza business subsidizing their real estate costs.
Right. They do not have an optimized nicotine back bar or an exclusive energy drink contract. They are entirely reliant on the razor-thin margins of selling fuel and a few basic snacks.
Yeah.
So when their operating expenses surge, they only have one lever to pull to avoid bankruptcy. They must raise the retail price of their gasoline.
I want to introduce an analogy here to visualize this dynamic.
Go for it.
The mom-and-pop gas stations are essentially like a fleet of sinking ships in a storm.
Okay.
The water is rising, representing their soaring operating costs. To stay afloat, they have to throw cargo overboard, which in this case means they have to raise their gas prices to the absolute maximum the local market will bear just to cover their fixed costs.
Right.
By doing that, they establish a high price ceiling. They create a price umbrella over the entire market.
And Casey's is navigating that exact same storm, but they are cruising in a submarine.
Yes.
They don't care about the waves on the surface because their engine is powered by a massive, highly profitable food and grocery operation.
When Casey's looks at the high price umbrella set by the struggling independents, they realize they have immense pricing flexibility.
Right. They don't need to match the high price to survive.
They can choose to price their gasoline 5, 10, or even 15 cents cheaper than the struggling operator across the street.
They basically use the fuel as a localized, high-visibility weapon.
Absolutely.
The consumer, who is feeling the macroeconomic squeeze of inflation, is aggressively hunting for value. They see the Casey's sign advertising gas 10 cents cheaper than the competitor, and they pull into the Casey's driveway.
Which perfectly explains the 1.5% increase in gallons sold. They were stealing market share purely on price.
But the absolute genius of the mousetrap is that because the independent operators raised the baseline market price so high to begin with, Casey's can significantly undercut them on price and still clear a record-breaking 46.9 cents per gallon in profit.
It's incredible. They capture the volume via relative value, and they capture the margin via the structurally inflated market ceiling.
And then, once that price-sensitive consumer is standing at the pump, the trap springs.
Yep. They look at the app, they smell the pizza, and they walk inside to execute a transaction that carries a 60% gross margin.
The cheap gas was merely the acquisition cost for the highly profitable inside store transaction.
And the management transcript provides concrete data showing that this consumer behavior is actually accelerating.
What's the data say?
They noted a massive spike in their loyalty program activity. Specifically, rewards program redemptions for gas discounts jumped 23% in the quarter.
23%. Right. That spike is a massive psychological indicator.
Oh, for sure.
It proves two things definitively. First, the consumer is undeniably feeling the pinch of inflation and is altering their behavior to save money on necessities.
Right.
Second, Casey's loyalty program is perfectly engineered to capture and retain that specific consumer.
By gamifying the discount, allowing customers to earn points on pizza and redeem them for cents off per gallon at the pump, they are locking the consumer into their ecosystem.
It's a brilliantly constructed, self-reinforcing flywheel. The consumer feels like they are winning by getting cheap gas, while Casey's is winning by driving recurring, high-margin inside sales.
But, executing this strategy across thousands of locations requires a massive operational apparatus.
And that apparatus costs money.
It does. We have to look at the expense side of the ledger. In Q4, operating expenses, or OPEX, increased by 10.1%, representing a $67 million jump.
On the surface, a 10% increase in expenses might trigger some warning bells for a fundamental analyst.
Sure, but we need to break down the composition of that increase.
Yeah.
CFO Steve Bramlage provided a highly granular breakdown of that OPEX jump, and it is vital for understanding their operational leverage.
Let's dissect that 10.1%.
So first, 2% of that increase is simply the cost of operating 40 more stores than they did in the prior year.
Which is entirely acceptable. It's the natural, unavoidable cost of physical expansion. You cannot grow your unit count without paying to turn the lights on and stock the shelves in the new buildings.
Exactly. That is productive expense.
Yep.
The next 1.5% of the increase was driven by store-level wage hikes. They had to increase hourly pay to remain competitive in a tight labor market.
Right.
However, the critical nuance here, and arguably one of the most impressive data points in the entire earnings call, is that while wages went up, same-store labor hours remained completely flat.
I mean, we really need to pause on that. This requires a deep dive into operational efficiency.
It's staggering.
Think about the mechanics of running a retail store. If you give your entire staff a raise, your payroll costs naturally go up.
Yeah.
But Casey's managed to absorb those higher hourly rates without letting the total number of hours worked inflate. In fact, over the last 3 years, they have managed to shrink same-store labor hours by roughly 5%, while simultaneously boosting employee retention by a staggering 70%.
And retaining employees is one of the most effective cost-saving measures in retail.
The hidden cost of turnover is massive.
Oh, it's huge. Recruiting, onboarding, training, and the inevitable drop in productivity while a new employee learns the systems. By paying slightly more per hour, they dramatically reduce turnover.
Which means their current workforce is highly experienced and highly efficient.
Right. They are running a leaner, faster organization.
They are processing more pizza orders, ringing up more grocery transactions, and managing a more complex menu with wings, all without needing to schedule a single extra hour of labor per week per store.
That is the essence of operational leverage, expanding output while holding fixed input costs steady.
Absolutely. Okay, continuing with the OpEx breakdown, another 2% of the increase was driven by credit card swipe fees.
Ah, the hidden tax of retail. And it ties directly back to the fuel price volatility we discussed earlier.
How so?
Well, credit card interchange fees are typically calculated as a percentage of the total transaction value. When the retail price of gasoline rises from $3 to $3.50 a gallon, the nominal dollar amount of the transaction increases.
Right, even if the customer buys the exact same amount of fuel.
Exactly. Visa and MasterCard take a larger absolute cut of this sale.
It is an unavoidable expense structurally tied to commodity inflation. Casey's cannot control the global price of oil, nor can they control the interchange rates set by the major credit card networks.
They simply have to absorb it, which makes their ability to expand margins despite this headwind even more impressive.
Definitely. Finally, the last roughly 4% of the OpEx increase was attributed to incentive bonuses and discretionary charitable giving.
The incentive bonuses are a direct reflection of the management teams and store operators crushing their internal operational targets. When the company posts a record $1.5 billion in EBITDA, the performance-based compensation naturally triggers.
Makes sense. But the charitable giving aspect is equally important to their long-term strategy.
Yes, CEO Darren Rebellis proudly detailed their philanthropic footprint during the call. They contributed over $8 million this year toward education, hunger relief, and veteran support. They distributed 100 specific grants to local schools, totaling $1.3 million, and provided over 10 million meals to food banks through their partnership with Feeding America.
And, from a purely analytical standpoint, while that $8 million is recorded as an expense, it functions as incredibly potent localized marketing.
Oh, absolutely.
When Casey's is the entity funding the new computers for the local high school or sponsoring the youth sports leagues, they embed themselves into the civic fabric of the town.
They transition from being just a retail transaction to being an institutional pillar of the community.
And that level of goodwill generates intense customer loyalty that a massive national chain just cannot easily replicate with traditional advertising.
It fortifies the spatial monopoly we discussed earlier.
It really does. Now, before we look at what management is predicting for the future, we need to analyze how they are expanding this physical footprint.
The final piece of the operational story. M&A and store growth.
Right. 3 years ago, management presented a strategic plan to Wall Street, promising to add 350 new stores to their network over a 36-month period.
And the investment community modeled out that target, assuming standard execution.
What Casey's actually delivered was a massive outperformance. They completed the 3-year plan by adding over 500 stores, beating their own aggressive target by more than 150 units.
A significant driver of that massive beat was their acquisition of the SEFCO convenience store chain.
Right.
They spent the bulk of the fiscal year executing the complex integration of these assets. They successfully converted 50 of those acquired CESU locations into fully branded Casey's stores within the fiscal year.
We really need to detail what a conversion actually entails because it explains a deliberate short-term drag on their sales figures.
Okay, lay it out.
When Casey's acquires a generic gas station, they don't just change the signage on the canopy and update the point-of-sale systems.
Right, they have to physically gut the interior of the acquired building. To implement the mousetrap strategy, they must install a full commercial kitchen, commercial ventilation, pizza ovens, and hot food holding areas.
Which means the newly acquired store is effectively operating as an active construction zone for 4 to 6 weeks.
Yeah, the aisles are torn up, the product assortment is limited, and the customer experience is temporarily degraded.
So those 50 SEFCO locations experienced a short-term hit to their operational volume while the heavy remodeling took place.
But as an investor, you look past the 6-week downtime and focus on the massive coiled spring upside.
Exactly.
Once those commercial kitchens pass inspection and open for business, Casey's introduces a 60% gross margin food program to a localized customer base that previously only viewed that specific corner lot as a place to buy low-margin fuel and a soda.
They fundamentally alter the unit economics of the acquired real estate.
They do. The capital expenditure of the remodel yields a permanent structural elevation in the store's baseline EBITDA. We expect to see the full financial impact of those 50 converted SEFCO stores flow through the income statement in fiscal 2027.
And their capital allocation strategy isn't just about aggressive acquisition. It is equally focused on disciplined divestiture. Management is not sentimental about underperforming assets.
Not at all. During the year, they proactively divested 41 stores, which included completely exiting their entire footprint in the state of Mississippi.
Wow, an entire state.
Yeah, and it generated $42 million in cash proceeds.
That is the hallmark of rigorous capital discipline. They analyzed the unit economics of their Mississippi operations and realized they were not clearing their internal hurdle rates for return on invested capital.
The supply chain logistics were likely stretched, and the market density wasn't sufficient to support their distribution model.
Rather than throwing good capital after bad in an attempt to turn around a structurally disadvantaged market, they liquidated the assets.
They took that $42 million in cash and are redeploying it into higher growth, higher density markets like Texas and Florida, where the returns are significantly more attractive.
Smart. So we have thoroughly examined the rearview mirror. We see a highly disciplined, ruthlessly efficient retail machine that just posted record profits, navigated commodity shocks, and vastly outperformed its own expansion targets.
But the stock market is a forward-looking discounting mechanism.
Exactly. It prices assets based on the present value of future cash flows. It does not care what Casey's achieved yesterday. It only cares what Casey's will achieve tomorrow.
Right. Let's transition to the future outlook. What is management signaling to the investment community about fiscal year 2027?
Tell us.
Translating the FY27 guidance reveals an astonishing level of confidence from the executive suite. Let's start with the most critical metric, EBITDA.
Okay.
Management provided official guidance projecting an 8% to 10% increase in total EBITDA for the upcoming fiscal year.
I want to pause and contextualize this because guiding for 8 to 10% growth right now is a massive flex by Darren Rebellis and Steve Bramlage.
Oh, that's a huge flex.
Standard corporate playbook behavior dictates that after posting an absolute blowout, record-breaking year with the 23% EBITDA growth, management will use the guidance to temper expectations.
Yeah, lower the bar.
Right. They will guide for flat growth or perhaps a modest 1 to 2% increase, citing tough year-over-year comparables. They usually want to intentionally lower the bar so they can easily step over it in subsequent quarters.
Instead, they are aggressively leaning into their momentum. Guiding for double-digit growth on top of a 23% record-breaking base implies a phenomenal 2-year stacked growth rate.
At the midpoint of their guidance range, they are projecting a roughly 35% EBITDA expansion over a 24-month period.
That signals to the market that the operational efficiencies they achieve, the optimized waste management, the nicotine mix shift, the wing rollout, are not temporary anomalies.
Right. Management views these improvements as permanent structural elevations in their earnings power.
And the underlying operational metrics support that bottom line confidence. They guided inside same-store sales to grow between 2% and 5%, while explicitly stating that inside gross margins will remain highly elevated.
Staying above that 42% threshold.
Exactly. They are not expecting a reversion to the mean on their food profitability.
And fuel gallons are guided between -1% to +1%, essentially flat.
Which is completely acceptable given the broader macroeconomic pressures on vehicle miles traveled right now.
Furthermore, they plan to add at least 120 new stores this year, evenly split between organic new builds and strategic acquisitions.
And to fund all this, they have budgeted roughly $590 million in capital expenditures,
which will be heavily skewed toward finishing the integration of the CATO network and upgrading the kitchen capabilities in their legacy stores. But while the inside store guidance is incredibly robust, there is a massive assumption baked into their EBITDA model regarding the fuel business.
Oh, the fuel margin assumption.
Yes. Management explicitly stated on the call that they do not officially guide fuel margins because wholesale oil markets are just too unpredictable.
Which is fair.
However, to construct their 8 to 10% EBITDA growth projection, they had to model a baseline assumption for fuel profitability.
And what did they model?
They stated they are modeling fuel margins in the mid-40s cents per gallon.
This is the linchpin of their entire forward projection, and it requires intense scrutiny.
Right. We established that Q4 fuel margins were nearly 47 cents per gallon, heavily aided by the high price umbrella created by struggling independent operators during a period of wholesale volatility.
Yeah.
If global oil markets stabilize next year and wholesale costs drop, won't the independent operators lower their prices to try and win back volume?
That's the big question.
By modeling mid-40s margins for the entire next year, isn't Casey's assuming that a highly volatile anomaly is the permanent new normal? Are they setting themselves up for a massive earnings miss if the fuel market normalizes?
It is the most vital risk factor to evaluate, for sure.
Yeah.
But Steve Bramlage provided a really compelling counter-argument based on the structural inflation of the convenience store industry.
I'm listening.
Historically, convenience stores' cents per gallon margins have tracked almost in perfect lockstep with the broader Consumer Price Index, or CPI.
Okay.
As the general cost of living and the cost of operating a business rise, the baseline fuel margin required to sustain a retail operation also rises.
Because the underlying fixed costs of the business do not deflate.
Exactly. We have to return to the plight of the mom-and-pop independent operator.
Yeah.
Their labor costs are not going down.
Yeah.
Their property insurance is not going down. The swipe fees they pay to the credit card networks are sticky. The baseline cost merely to exist as a gas station has permanently shifted higher over the last 3 years.
I see where this is going.
Because the independent operator's break-even point is permanently higher, the price umbrella they create over the market is permanently higher.
Wow.
Therefore, Casey's ability to price underneath that umbrella and still capture mid-40s margins is structurally sound. Management isn't assuming the anomaly will persist. They are recognizing that the entire floor of the industry's profitability has been permanently recalibrated.
The weakest, least efficient player in the local market dictates the margin ceiling, and because that weak player is drowning in structural inflation, Casey's reaps the windfall.
That's exactly it.
I followed the logic and it makes mechanical sense. But what about the ultimate variable in the retail equation? The consumer.
Right, the person actually buying this stuff.
If the consumer's balance sheet breaks under the weight of sustained inflation, the entire mousetrap falls apart. Does management have visibility into the actual health of their customer base?
They provided a fascinating, highly granular health check on their consumer cohorts. Casey's internally tracks spending behavior segmented by household income tiers.
Okay, break them down.
Those making below $50,000 a year, those making between $50,000 and $100,000, and those making over $100,000.
The behavioral data across those tiers is crucial for understanding their recession resistance.
It is. Management reported that, surprisingly, nominal spending growth is occurring across all three income brackets.
All three?
Yes. However, they did acknowledge some softness in the lowest tier. The under 50,000 cohort is undeniably feeling the macroeconomic pressure.
Which is to be expected.
They are exhibiting trade-down behavior, perhaps swapping a premium energy drink for a private label soda, or reducing their overall basket size slightly.
Right.
But the critical insight for investors lies in the composition of their customer base. The top two tiers households making over $50,000 a year represent a massive 75% of Casey's total customer base.
75%.
And according to the transaction data, those upper tiers are spending identically to how they have spent in previous years. There's absolutely no degradation in their purchasing behavior.
This demographic breakdown illustrates why Casey's operates as an incredibly defensive consumer staple.
It really does.
Their real estate strategy intentionally targets rural and suburban markets, catering heavily to daily commuters, local tradespeople, and families.
For these demographics, Casey's is not a discretionary luxury.
No.
It is an integrated necessity of their daily routine. They require fuel to commute to their jobs, they rely on the convenience of the grocery aisles, and a $14 large Casey's pizza remains a significantly cheaper dinner solution for a family of four than visiting a sit-down restaurant or a fast casual chain.
Yeah, the macro environment would have to degrade significantly to alter the behavior of that core 75% demographic.
So true.
Well, we have dissected the historical financial records, we have broken down the operational mechanics of the three-lever mousetrap, we have evaluated the M&A pipeline, and we have stress-tested the forward guidance.
It's been a ride.
It is time to synthesize this data mountain. We need to translate this deep dive into actionable intelligence. Based on the fundamental reality of this business, as presented in the Q4 transcript, what is the ultimate signal on Casey's General Stores? Are we fundamentally bullish or bearish on the trajectory of this company?
Based on the sheer strength of the operational leverage, the discipline of the capital allocation, and the unreplicable nature of their localized spatial monopolies, the signal is an unequivocal, resounding bullish.
I am in complete agreement. The fundamental thesis here is exceptionally strong. Let's summarize the core why for anyone evaluating this business model.
Yeah, let's wrap it up.
You are not buying a traditional gas station. You are buying a highly defensive, cash-generating consumer staple business that is executing a flawless roll-up strategy within a deeply fragmented industry.
Perfectly said.
They are systematically capturing market share on two entirely different fronts simultaneously. On one side, they are taking share from multi-billion-dollar national pizza chains by utilizing their sunken real estate costs to hold the line on price.
And on the other side,
they are suffocating local independent gas stations by leveraging their massive inside store food profitability to subsidize highly competitive fuel prices. Add to that their proactive shift into high-margin nicotine and exclusive beverage products, and you have an operational engine that is firing on every cylinder.
and we must emphasize the unassailable nature of their operational moat.
Yes, the moats are deep.
The barriers to entry in their specific markets are staggering. Firstly, they operate a vertically integrated distribution network. Remember the chicken wings we discussed earlier?
Yep.
Management specifically noted that they supply all of those wings and the vast majority of their proprietary food and grocery items out of their own centralized distribution hubs, like their massive facility in Ankeny, Iowa.
So they aren't farming that out.
Exactly. They do not rely entirely on third-party food service distributors like SEFCO or US Foods for their core products. By controlling their own supply chain, they ensure absolute consistency across thousands of stores and capture the middleman's margin, retaining more profit internally.
And secondly, the physical real estate moat.
This is key.
In a town of 3,000 people in rural Nebraska or Iowa, the localized population density is simply not sufficient to support a standalone Domino's pizza, a standalone Kroger grocery store, and a standalone BP gas station.
The unit economics for three separate businesses just do not work.
Casey's builds a single, highly efficient box that serves all three purposes simultaneously. Once they establish that footprint, they become the de facto hub of the community. No rational competitor is going to deploy millions of dollars in capital to build a rival store directly across the street because there is not enough residual consumer demand to support a second player.
It is a textbook example of a localized spatial monopoly protected by the hard math of population density.
For the retail investor evaluating their portfolio strategy right now, the actionability is clear. If you currently hold the equity, this represents the archetypal sleep well at night compounder. It is a core holding.
You are collecting a dividend yield that has demonstrated unyielding growth for 27 consecutive years, spanning multiple economic crises.
While you collect that yield, the management team is actively shrinking the outstanding share count via a $1 billion buyback program, effectively increasing your fractional ownership of the company's future cash flows every single quarter.
And if you are actively researching the stock for a new position, the focal point of your thesis should be the 12.7% return on invested capital.
Right.
When an executive team proves they can deploy hundreds of millions of dollars into acquiring smaller chains like SEFCO, stomach the integration costs, and still generate nearly 13% internal returns in a macroeconomic environment defined by a 5% risk-free rate.
That M&A strategy is massively accretive to long-term shareholder value.
They are not empire building for the sake of top-line vanity. They are methodically deploying capital to compound their earnings power.
It is a masterclass in operational leverage and spatial dominance.
But, as with any deep dive, our analysis of the historical data and present reality must ultimately give way to questions about the long-term future.
The retail landscape is never static.
Before we conclude, there is a profound, forward-looking strategic question that investors need to consider as we look toward the next decade of convenience retail.
Let's hear it.
We have spent an immense amount of time establishing that the core genius of the Casey's mousetrap relies on a very specific behavioral sequence. The consumer has an absolute necessity to purchase liquid fuel to power their vehicle.
Right.
Casey's uses that non-discretionary necessity to lure the consumer onto the physical property. Once the vehicle is parked at the pump, the psychological trap springs. The consumer is enticed inside to execute a highly discretionary 60% gross margin transaction on pizza, wings, or an energy drink.
The low-margin fuel acts as the vital physical magnet for the high-margin food.
But look at the secular trends shifting the automotive industry over the next 10 to 15 years. As electric vehicle adoption slowly but inevitably permeates the rural and suburban Midwest, the fundamental mechanics of the fill-up-ication will undergo a radical transformation.
Wow.
The transaction will shift from a 3-minute dwell time at a gasoline pump to a 20 or 30-minute dwell time at a level 3 fast charger.
Or, perhaps more disruptively, for a massive segment of the population, the entire transaction of refueling will migrate away from the commercial retail space entirely and shift to the consumer's own home garage overnight.
This represents an existential shift in the mechanics of the mousetrap. If a significant percentage of their customer base no longer requires a weekly visit to a physical gas pump to fuel their daily commute, how does a convenience store maintain its vital, high-frequency foot traffic?
When the core magnet of gasoline loses its universal pull, does the entire ecosystem fracture?
It forces us to ask how management will adapt the physical footprint of the real estate. Will Casey's pivot their massive capital expenditure budget to become charging oases, attempting to capture the consumer for 20 minutes and shifting the inside store layout to accommodate a longer dwell time? Perhaps adding sit-down dining areas for the wing and pizza consumer while they wait for their battery to reach 80%.
Or, even more provocatively, will the quality and value proposition of lever A, the 60% margin prepared food operation, become so powerful and so deeply ingrained in consumer habits that Casey's Pizza becomes a standalone destination?
That's the dream.
Will the food become the primary magnet, driving consumers to drive to the physical location specifically for dinner, regardless of whether their vehicle requires a charge or a tank of gas? Can the restaurant survive without the pump?
That is the multi-billion-dollar strategic question for the 2030s. How a legacy fuel operator navigates the energy transition while protecting their high-margin inside sales will define the next era of convenience retail.
It requires an entirely new framework of capital allocation and consumer psychology.
It does.
And exploring those exact types of complex structural questions is exactly why we do this level of research. It is easy to glance at a headline EPS number on a financial blog and make a snap judgment.
But there is immense portfolio-defining value in rolling up your sleeves, reading the full transcripts, understanding the mechanical reality of how a business operates, and identifying the localized moats that protect their cash flows.
Look for the businesses in your own portfolio that exhibit hidden pricing power, the ones that dictate terms to their competitors rather than reacting to them, and the ones demonstrating the capital discipline to compound your wealth regardless of the macroeconomic weather.
Keep challenging your assumptions.
Keep doing the hard math and keep joining us here for the ultimate fundamental edge on the deep dive.